Mike Douglas is Michigan's retirement coach.
Public service announcement, everybody. We've made it to the month of May. Mother's Day is upon us. Mother's Day is upon us. Seems like every holiday has the magical ability to sneak right up on us every single year, Mike.
Yeah, another holiday. Yeah, they just keep popping up.
And you and your beautiful wife, Kimberly, have 4 lovely children. Is there any kind of Mother's Day traditions happening in the Douglas household?
Well, we're very grateful, but we live very close to my parents and her parents.
Yeah.
So Mother's Day is not really about
It's not about her.
It's not about her. It's about her mom and my mom.
Got it.
And we still do stuff, to celebrate Kimberly. But Mother's Day itself, it's going to be at her parents. We'll probably be at my parents to celebrate my mom. And that's what it should be.
That's okay. Yeah.
Eventually, that'll be our turn.
Got it.
But as of now, that's what we do.
Got it. Well, happy Mother's Day to you, moms. Couldn't do a lot of things without you. Let's talk about the work that you're doing as far as helping people do the things they want to do in this retirement journey, whether that's treating themselves various holidays throughout the year, taking vacations, spoiling their kids and grandkids. That's also a big priority for a lot of retirees, understandably. Mm-hmm. With our nest eggs and what we can do with them. A lot of people have a lot of questions because of all the headlines that we're seeing flying about. They change 180 day in, day out, it seems. But despite all of that, Wall Street just don't care. She's over here just acting like nothing's going on. The market has definitely piled up some solid gains lately, even despite economic volatility. This is Taylor Riggs with Fox Business.
When you look at the fundamentals, the S&P 500 revenue is up 12.5%. Earnings are up 30%. Things are good for now. But this is a market that's thinking 6 months from now, things are going to be a lot better than they are today.
This is a market that's thinking 6 months from now, is what she said. Now, if the market's always trying to price in what's coming next, should we as investors be doing the same? Are there signals that you as a financial advisor and a financial planner that you trust more when you're trying to help somebody make decisions, somebody who's close to retirement?
Yeah, there's a lot of thought that goes into that in terms of what is, and we use the phrase quite a bit, signal versus noise. I took it from a podcast that I listened to where they teach on how to navigate these things. But there is noise and there is signals. Noise would be the headlines. Noise is like the Iranian conflict. It's a real thing, but what effect is it having on our economy? Right. It has some temporary effect on gas and some inflationary things, but our companies, because when you invest in the stock market, you're rarely investing in the price of oil. You're investing in the companies. Now, a lot of those companies use oil or gas or whatever, but how is a company able to navigate these changes? Are they still making money? Is revenue still up? Is their earnings per share appropriate? Like, there's a lot of stuff that goes into it. And when you think of it that way, companies are still making money. Our domestic economy is still doing really, really well. But yet the headlines are freaking out. But the market knows how to price it in. When the conflict first happened, every day was like a -2%, -3%. And then it'd be good news, +2, +3%. Now on the same type of news, the market's only moving about 0.5%. So what we're seeing is the water has found its level a little bit. It's figured out how to price things in. I just had someone who came in recently. It's a client, but they came back in saying, I feel like I just need to figure out what's coming next before I make a move. Like, what's going to happen next? The reality is, by the time something feels certain, the market's usually already adjusted.
Okay.
It's called efficient market theory. I don't want to get too nerdy on it on a Sunday morning, but here's what it is. If you've heard it, the insiders already know about it. Right? Think of it like any gossip column or any news about a celebrity you hear, or trade details like for the Lions, or all these. I know we're going to talk about the NFL draft coming up, but like anything that you hear as a regular person, trust me, the people inside the offices at the Lions have already talked about. The people on Wall Street have already talked about. Insiders and money market makers have already heard about it. So when you think you get a hot stock tip on, I think Amazon's going to do real well next year. Yeah. We know. They all know.
Yeah.
So the idea that we can try to beat it and deal with it, it's very unlikely. That's why trying to predict the next move often leads to missed opportunities and bad timing. Should investors try to price in the changes? I think we just need to understand that the market is going to have its cycles. It's going to be good most of the time. It'll be bad some of the time. That's a historical trend. 7 or 8 out of 10 years in a decade are almost always positive. And 2 to 3 out of a decade are negative. So as long as the positives outweigh the negatives, it's a good decade. And it has been historically, except for 2000 to 2009. Other than that, the market makes money decade over decade. So when we look at our money, and just like I sat with our client, I said, I know you want to feel certainty before you make a move, and that's okay. What I think we need to do is take our money and say, how much certainty do I need? And then how much risk am I willing to take? And separate those piles of money.
Okay.
That was his biggest concern. He was saying, before I make a decision on any of my money, I want to feel good about all of my money or all of the market.
Okay.
Which is fine. But we said, let's separate it into income and investment. That was a change of thought process for him. He was saying, because remember, he came in, he had about $1.2 million. And as we're walking through his plan, he's like, I'm afraid to put any of it in the market because what if it loses? Then as we kept boiling down, why? What are the concerns? What is the money supposed to do for you? We really figured out he's talking about he's afraid that he won't be able to pull income out of this thing because the market's down.
Okay.
If this is you and you've been in this position, or maybe you're in this position right now, I'm paralyzed by what's going on. I just, I've got that analysis paralysis. I can't move. I'm waiting. And yet I know waiting isn't the right thing to do. I should be taking advantage of opportunities. Then give us a call. We will help you understand how to navigate markets like this one. How do I deal with bad headlines and good market returns? Then at some point, it feels like these things are going to flip. How do I deal with that? Give us a call and we will help you understand how your retirement can be built for the good times and the bad. 616-512-2127 or reach out to us at michigansretirementcoach.com and we will walk through, understand your situation and give you some feedback on what we see, think, and hear about your portfolio and help you understand the process we go through in getting clients and leads prepared to go through this. People that call in from the radio show, they're not clients. They're just people trying to get some information. They're regular people here in Grand Rapids just trying to navigate the stock market, trying to navigate inflation, trying to navigate the challenges of affordability right now and helping people figure that out. That's what a fiduciary level care looks like. It's sitting down with people and saying, hey, I understand why. Let me educate you on how to navigate it and see what we can do to help. That's what it looks like. So trying to price it in, trying to figure out the market, that's really tough. The market reacts instantly to new information and individual investors are usually late to the move. Trying to predict it often turns into guessing because we take, the average person will take like 2 or 3 headlines and try to formulate a guess on it and call it an informed decision. Meanwhile, the investors in Wall Street and the people who do this professionally, they're taking thousands of data points to make the same decision. So they just have so much information. And so you're really not making as much of an informed decision as you are a guess, because I could probably find 3 to 4 pieces of information to counter your argument.
They would directly conflict.
And that used to drive, I know Kimberly and I were talking, I remember during COVID specifically, and COVID had wild swings during that 33% crash in 22 days. One day the market dropped 10% and it was chaos and everything was freaking out. And the next day the market went up 11%. Using the same headlines. And I took a picture of it and I showed it to Kimberly. I said, Kimberly, if you want to know why today was stressful at the office, here's why. And I showed her 2 days in a row. I had headlines of the same information about COVID and about the world and everything else. One was a negative 10% day. One was a positive 11%. So the idea of trying to pull the needle out of the haystack to be the one to beat the market is really, really tough. The market is forward looking. Your plan should be resilient. Your plan should be built to be successful when the market's good and opportunistic when the market's bad. So with our client who came in, he had that $1.2 million. And as we went through it, we said, all right, what do you really, really care about the most? And we were able to boil it down to he wanted income. He was afraid that the market being down meant he couldn't live the lifestyle he wanted to live. So then we said, all right, well, out of this 1.2, let's separate a piece off. Take care of your income through some dividends and through an indexed annuity. And those things combined give him all the peace of mind and security he needed. And then from there, the rest of his money could go over and be opportunistic. The market's bad. Let's buy things that make sense and let's get out of things that don't make sense. And then when the market's good, let's participate in the good parts of the market. It took the stress out of it and gave him confidence to know, all right, if a down market's happening, my monthly income doesn't change, but my investments will adjust and change to take advantage or to protect. Sometimes everything's bad. In 2022, stocks and bonds both fell 20%.
Right.
So I had one client who said, there's nowhere for me to rest my eyes. And we laughed. We said, it's right. This is a very unique situation. Let's back out of the market and let's protect. Other times, though, we see tech dropping, but other things growing. And so we move. We don't get out. We reposition towards things that are making money or being stable. There's opportunities to be successful in any market, as long as you know that your necessities, your lifestyle, your needs are covered through some type of guaranteed or secured income. That gives you the peace of mind to let the rest of your investments go and do what they're supposed to do. This is the difference in a strategy that is built for all markets versus one that says when the market's good, you live this way. When the market's bad, you live that way. We don't want that. If your strategy depends on getting the next move right, that's a risky place to be, especially near or in retirement, because the goal isn't to predict the market. It's to build a plan that works, whether you're right or wrong. Right now, it's a tough year. News is bad. Market's good. Why? I don't know. From March 22nd of 2020 through the balance of the year, the market went on a tear making money every single month, despite the fact that we had just been put into our homes. We had just been under stay-at-home orders. Despite the fact that businesses were closing and the GDP was down, the market ran up for 9 straight months. Why? We have no idea, but it did. So how do you make it so that it participates the right way in both markets? Have a plan that's made for you and your family. If you'd like us to show you how to have a weatherproof and a newsproof portfolio that says, here's how we live successfully, give us a call, 616-512-2127, and we will have that conversation. You and I on the phone talking through your portfolio. When you call in, you'll talk to one of our team members. They will get you set up with a time for you and I to have a phone call, and we will just hear your story, hear what you want life to look like, and see if you're set up right, and we can get together and talk it all through. So 616-512-2127, or you can reach out to us at michigansretirementcoach.com.
All right. So yes, it's spring. It's baseball season. Even though the NBA playoffs are still going on, the NFL draft just happened. God bless America, man.
Hockey playoffs are on.
That's what I was saying. Like any opportunity for professional sports, let's just shove them all in. The NFL draft did just wrap up. How'd the Lions make out?
Pretty well.
Yeah.
I was happy with the draft picks, an offensive lineman and a couple edge rushers and a couple good spots. I thought they did a good job this year. Most people are grading them out pretty high. Yeah. It's not a very sexy draft the way that others, you didn't get a new quarterback or all these things, but a new offensive lineman keeps your quarterback better. So I think it went pretty well.
Well, for the players who did get drafted, it's a dream come true. They've beat the impossible odds. They've signed the contract, and we've spoken before about the tragic stories we have heard about professional athletes and the financial circumstances many of them end up in, Mike. What can happen for some of these guys when one bad decision is made and everything they work for starts to unravel? The truth is, the same can be said when it comes to our savings and our retirement. You saved, you planned, you made it to retirement's doorstep, and then something can go sideways, and perhaps you don't have the right plan in place to factor things in. Is there a retirement equivalent to one bad decision that can change everything?
I think that when you retire, you are looking to create a new life, and it's built on the life you've lived. Yeah. And when you retire, you have a vision for the future. And what you're looking for is someone to help you get that vision accomplished. I have some clients, Bob and Nancy, and Bob retired from Ford in 1999. And when he retired, they had about $1.8 million. And he was pretty young. He was in his late 50s. And the whole idea was, now we have enough money, we can live off of this. And he was a very smart guy, did accounting for Ford. He always joked, he goes, I was the best bean counter in the building, and he went through all that. And he retired, and he found a financial advisor who turns out was not a fiduciary level financial advisor. He was just a suitability advisor, someone who could sell products. He worked for a very big firm. So that gave Bob some confidence that, hey, it's a big firm, like it's well known. So I'm sure if things go wrong, I'll be taken care of. Well, in 2000 through 2003, we had the dot-com burst where all the stock market, the stock market went through a really hard time. And over the course of 3 years, the market lost 43%. Now, when they retired, the idea was we can pull out about $4,000 a month off this $1.8 million and be okay the rest of our lives. And that was a strategy. So they had the 1.8 million. The market loses 43% over the next 3.5 years. And every time he would check in with the financial advisor at this, I'm not going to say the name, but a really big firm, the guy would tell him, listen, this is the natural ebbs and flows of the market. You got to be able to roll with it. You have to be okay. And he stayed in and he trusted this person. And then the market bottomed out and it started recovering finally. So he started feeling a little better, but his 1.8 got down to about 1.1 million in the first 4 years of his retirement.
Wow.
So loses more than a third of his money in the first 4 years of retirement. And now he's like 62, 63 years old. And he is starting to stress out. The market starts to recover up until 2007. So he gets back up to about 1.5 million. And the advisor, again, the market's going up. So the advisor's like, see, look what I'm doing for you. But really the rising tide was floating all the boats and he was going back up.
Yeah.
And then October 15th of 2007, the stock market starts to crash and it crashes for 18 straight months. And after about 4 months, he calls the advisor and says, hey, listen, this is going down. I can't be part of this. It's stressing me out too much. And the advisor says, I hear you. I'm going to reposition you into something that will make your money back. This is temporary. So he repositions him into the financial sector. And the financial sector, towards that end of the year, is supposed to be doing well for him. It lost more money. After another 3 months, Bob calls him and says, hey, I'm telling you, I want to get out. This is not good because now I'm down to about $1 million. The guy says, I hear you, but Bob, if you don't sell, then you haven't lost. It's a paper loss. You got to hang through this. You're new to this. I work at this big firm. We do the analysis. We do all this stuff. And Bob says, okay. 3 months later, he loses more money. Now he drives to the office and waits outside for the guy like it's Mike Wallace with 60 Minutes back in the day. And just he's waiting for him. Yeah. And the guy comes in. He goes, get me out of the market. I don't understand what you're doing. Why are you keeping me in? I've told you I want to get out. I want you to get out. And you're supposed to be the genius and you're the one who keeps losing me money. This all comes to a head. He finally fires the guy as he's sitting at $600,000 in his retirement accounts total. Oh, wow. $600,000. Wow.
Yeah.
So what does he do? He fires the guy. He goes to Walmart and buys 2 big screens and a new computer and sets them up and goes back to work full-time managing his portfolio. And that was stressful and it was anxiety ridden.
Yeah.
And he worked like a dog. And from 2009 until when he met us in 2018, he took his $600,000 and grew it to $2.2 million.
Wow.
And he lost years of his life committing to working this thing. He would be up every morning at the computer by 7 a.m. and wouldn't leave until 4:30 after the market closed. And that was a full-time job 5 days a week for him.
Yep.
No longer retired.
Yep.
And it was very stressful for him and very stressful for Nancy. And by the time he comes to meet us, we're talking through it. And he's like, financial advisors are the worst. I said, well, non-fiduciary care is the worst. I agree with you.
Okay.
We went through, helped him understand. We worked through some planning and some processes. And when we finally partnered together and took over his portfolio, he and his wife both said, this is the relief we've been looking for. I can finally retire again.
Okay.
And it was a life-changing experience for them. So the number one mistake I think you can make, that's a long answer to a short question of what's the number one mistake. I think the biggest mistake you make is not working with the right person.
Okay.
Someone who is not a fiduciary, someone who's not a CFP, someone who is not out for your best interest and not legally held to your best interest. And oftentimes I find that the best results don't come from a big box firm, but it comes from a local person who knows you, knows your family, and can help.
Yeah.
That's who we are. That's Life Plan. That's Michigan's Retirement Coach, a local firm helping people retire with dignity, retire the right way. If you'd like to have a conversation about that, what that looks like and how it works in your life, give us a call, 616-512-2127, or reach out to us at michigansretirementcoach.com.
Okay. Let's do some Finance 101 here about Roth conversions. Roths and Roth conversions have been one of the hottest topics in the world of financial and retirement planning that I personally have seen over the last 5 years. And there are many benefits, which is why they've been such a hot topic. But the question about when you should do a Roth conversion is a big one for a lot of pre-retirees and retirees. financial author Sean Mullaney was telling Morningstar he believes that there is a sweet spot to do one. And he says it's between ages 66 to 69. So this is Sean Mullaney.
So these 4 years, the world tends to be our oyster. And during these 4 years, we have a high standard deduction. And we now have the senior deduction. Now that's quote unquote temporary for 4 years. We'll see if that is really temporary or not. But regardless, these 4 years tend to be the best Roth conversion years because we don't have required income. We could delay Social Security. We're not managing for premium tax credit. These are the 4 years I think most retirees should be most thinking about Roth conversions.
All right. So again, he says that the sweet spot on when to do a Roth conversion is between ages 66 to 69. So what do you think, Mike? Is he right?
Well, this is one of those great things about finance is that a lot of times there is no specific absolute answer for people.
Okay.
It depends on priorities.
Yeah.
Right. In the same way that he was like, we could delay Social Security and take it later. Well, that depends on priorities. You could take advantage of these extra benefits. That's true. I think you should absolutely take advantage of every tax credit we get. And we do have the Social Security tax credit that's being given right now through 2028. However, some people would say 66 to 69, and they tend to think that beyond that, maybe I'm not getting the return because I'm going to pay these taxes and I won't get the money back before I die. So my kids get more tax-free money. And I can agree with that, except for when people say, would you rather get, I ask them, would you rather give the money to the government or to your kids? Well, my kids. Okay, well, then it's still worth it.
Okay.
So it depends on how high in a priority system inheritance is would determine the sweet spot, in my opinion.
Okay.
Our goal is always this: retire young, retire well. And if we can get you out earlier than expected, it actually gives us a long runway to when we can do Roth conversion. So for example, let's say that you want to retire at 60 years old. If we retire you at 60 and you don't have any required minimum distributions until you're 75, then that gives us 15 years to Roth convert and try to get rid of your pre-tax money before your RMDs kick in. The beauty of Roth IRAs, there's no required distributions at 73 or 75.
Right.
It's your money. It's off the grid. You get to earn tax-free interest the rest of your life, and it passes on to your kids as tax-free interest. That's a beautiful thing. However, if you're still working at 60, 62, 64, 65, 67, right? Well, then we start figuring, does it still make sense the same way? Is it still as advantageous, or should we be waiting? The other thing to think about is whether or not you should take Social Security. That's one of the big topics people ask. When do I take my Social Security? Should I be taking it early so I get as much benefit out of it? Should I be holding later so I get more money per month? And it's funny, we post our podcast that we do to YouTube, and the most hate and vitriol I've gotten on anything we've posted was when I suggested people take Social Security early. I just noticed that the other day. I was going through some old clips and I saw that. People did not like it. They said, you're only saying that so that you get to keep more of the client's money and make fees off of it. That was the whole concept.
Seriously?
Their anger, that was the anger that I got. And I thought it was really interesting because my reason is actually the opposite. My thought is, I want your money that you save to be for fun, not for need. And so when you take your Social Security, I also see too many people die in their late 60s, never having gotten hardly any Social Security out. Like you've paid in for 40 years and then you wait till 70 to get the most bang for your buck. And then you pass away. Men on average right now, they say actuarially 77 or 78 years old. So you pay in for 40 years to get paid for 7. I can't get on board with that.
Yeah.
I'd rather people get paid for 18 or 20 years and then supplement it and do all the fun stuff with your retirement savings. So I think that's a big part of it too. When do I take Social Security? I tend to encourage people, not everybody, I tend to encourage people to consider taking it as early as possible because every year that I wait, I get 8% more. However, I just gave up a year of income to get it.
Yep.
So I may be giving up $20,000 for 5 years to eventually get $300 more a month. And I just really struggle with some of that math. I'd rather get out sooner, especially knowing I've had some friends, even someone who worked here, our old CEO, passed away, unfortunately, way too young.
Yeah.
Never got his Social Security benefits, but paid in his whole life.
Yep.
There's no check cut to his family. There's no benefit given his family. It's nothing. If he had just taken it earlier, he could have gotten it. So I tend to lean towards early Social Security. I tend to lean towards those things. But going back to Roth conversion, if I'm taking this income, I'm creating a taxable event that will probably trigger taxes and so on and so forth. It just needs to all be built into the equation. How much can I afford to do? How much is appropriate to do? And am I going to be taxed beyond acceptable limits? If we look at, can I get my money all converted before 75 or 73 when your RMDs kick in? That's a great thing to look into. Can I get it there? Also, if I have $1 million, $2 million, whatever the number is, how much is going to go to my kids and how will it be taxed when it goes to them? Well, I've got this account and this guy, I got this house, I have these things. Well, what is your estate plan set up? How is the money passing on to the kids? Well, I have 401ks and that's going to go to my kids and they're going to get $1 million each in an IRA, which means that they will have to pay taxes on that in 10 years. You give them $1 million, they have to pay taxes on the whole $1 million within 10 years, which means they're going to be eating a pretty heavy tax bill. Versus if we Roth convert it, now that money's passing on to them tax-free. Now, do I think taxes will be higher in the future when these kids inherit it? Or do I think it'll be lower when they inherit it? I have to assume it's going to be higher because taxes are historically low, levels of the Great Depression. If the taxes are really low right now and very inexpensive for most people, then why wouldn't we load up on taxes now? That way in the future, when it passes on or when I use it, if taxes go way up, I've already paid the tax. So I know that the sweet spot, according to Sean Mullaney, is 66 to 69. But for me, it's however young we can get you to retire up until your required distributions kick in. That to me is the sweet spot. Getting it done before then, because even if, let's say you convert at 74, your last dollars that you convert are done at age 74.
Yeah.
Well, what are the odds of you making money back on that? Well, if you think of it over your life and the first 10 years after that, when your kids inherit it, there's a good chance that it was a great financial decision. More money passes on tax-free to the kids. The government doesn't get to come in and take a swipe out of it before it ever goes on to your kids. We avoid estate tax. We're doing a lot of stuff that can help us really bring down our taxable benefits. So we want to create a good situation where we get as much income as possible, as little taxation as possible, but appropriate taxation. Right? You're going to have to settle up.
Right.
You're going to have to pay taxes on it either in your life or over the first 10 years after your death. We might as well look at it from the perspective of how much do I pay total, whether it's in my life over the 10 years after. And I bet if you look at it from that perspective, if your kids inherit your money at 55 years old and they're still working and they have to pay taxes on it then, it's going to be taxed at a way higher rate than if you just Roth converted it now. So there's a lot to think about. It's not as simple as 66 to 69. It's not as simple as once you're 70, it's too old to Roth convert. And it's also not as simple as just do as much as possible. You have to navigate your Social Security benefits. You have to navigate the fact that it's going to raise your Medicare premiums potentially. There's a lot that goes into it.
Yeah.
But again, if we can retire young, retire well, and retire on time, that's all we want to do. When does it make the most sense for my family? How can we live the right life? How can we pay as little in taxes as possible? But at the same time, look at the longevity of taxes and income and all of our planning and pay the right amount. Take control of your taxes. Do Roth conversion on your terms, not the government's. Don't allow them to come through and annuitize your retirement accounts. Understand how it works. If you're thinking about Roth conversion, don't just ask when. Ask how much and how often. Because done right, it can save you a lot in taxes, but done wrong, it can cost you just as much. That's what we do. Help people retire and Roth convert the right way.
Mike and his team, they're here to help guide you through this process because at the end of the day, the goal is that you're going to retire one time. But Mike and his team, they're retiring every single day. We're helping folks do that. So they got a lot of wealth of knowledge in their pocket that they're ready to share with you. MichigansRetirementCoach.com is our website where you can go to start the conversation with Mike and his team or click on the links we got posted in the show notes.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit MichigansRetirementCoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.